$600 billion disappeared. Lehman Brothers was supposed to be one of the safest names on Wall Street. Instead, its collapse helped push the entire global financial system into panic. New York skyline, Wall Street traders rushing into work, Lehman Brothers banners hanging on a glass tower. This was not a tiny company nobody had heard of. Lehman Brothers was a 158-year-old Wall Street institution. It had survived wars, recessions, and market crashes. It looked permanent. That was the illusion. Fast cuts of office buildings, trading floors, mortgage paperwork, luxury homes, smiling bankers closing deals, stacks of loan files moving across desks. In the years before the collapse, America was deep in a housing boom. Home prices kept rising. Banks kept lending. Investors kept buying mortgage-backed products. And the system kept rewarding whoever could grow the fastest. Suburban neighborhoods under bright sun. For sale signs flipping to sold, mortgage brokers shaking hands, families signing papers. The logic looked simple. House prices seemed like they would keep going up. If that was true, almost any mortgage could be turned into profit. That belief became fuel. And Lehman wanted more of it. Lehman trading desk. Screens full of numbers. Executives in conference rooms pointing at growth charts. Lehman aggressively expanded into real estate and mortgage-linked assets. It loaded its balance sheet with exposure tied to housing. The bet was huge. As long as housing stayed strong, Lehman looked brilliant. If housing cracked, the danger would be everywhere. Balance sheet graphics. Bars rising higher. Leverage meter climbing into red. And this is where the story gets dangerous. Lehman was not just making a housing bet. It was making that bet with extreme leverage. That means it was using borrowed money to amplify returns. Leverage makes good times feel incredible. It also makes bad times fatal. A tall tower of blocks stacked too high. One small piece shifts. The whole structure starts wobbling. Think of it like this. If you own a small house with mostly your own money, a drop hurts. If you own a giant tower built mostly with borrowed money, a drop can destroy you. Lehman built the tower. Mortgage delinquency notices, falling home price charts, news headlines about defaults rising. Then the housing market started to weaken. Defaults increased. Mortgage products that once looked profitable started losing value. And the market began asking a terrifying question. How much bad risk is really sitting inside these firms? Close-up of nervous traders. Phones ringing. Screens flashing red. Conference rooms going silent. That question matters because finance runs on confidence. If people trust your numbers, they will lend to you. If they trust your balance sheet, they will trade with you. If they stop trusting either one, the machine starts freezing. Lehman executives entering meetings. Reporters outside. Headlines building pressure. Lehman tried to reassure the market. It said it had liquidity. It said it was managing the risk. It said the business was under control. But trust was weakening faster than the reassurances could work. Simple graphics showing assets on one side and debt on the other. Debt tower growing taller. A highly leveraged firm depends on constant market confidence. It needs funding. It needs counterparties. It needs everyone to believe the firm is stable enough for one more day. Once that belief starts to break, time becomes the enemy. Red stamp. Mark to market. Property values shrinking. Mortgage securities repriced downward. As markets repriced mortgage-related assets, losses became harder to hide from reality. Assets that once looked valuable were now worth much less. And when a leveraged firm holds too many assets that are falling at once, every dollar of decline hits harder. Pressure on faces. Trading floor chaos. Executives watching TV coverage in silence. Now the story turns psychological. this was not just about numbers. It was about confidence collapsing in real time. The market started asking not, is Lehman strong? The market started asking, who wants to be left holding the risk if Lehman fails? Dominoes lined up across a dark table. One starts tipping, others begin to fall. That shift changes everything. Because once fear enters the system, every institution starts protecting itself. Lenders pull back. Counterparties become cautious. Cash becomes precious. And a firm that looked massive can suddenly look fragile. Weekend emergency meetings. Government buildings at night. Executives arriving under camera flashes. By September 2008, the pressure was intense. There were efforts to find a rescue. There were talks. There was hope that some kind of deal could stop the collapse. But hope is not capital. And confidence was evaporating. Empty boardroom chairs, scrolling headlines, breaking news graphics. Then it happened. Lehman Brothers filed for bankruptcy on September 15, 2008. One of the biggest bankruptcies in American history. A firm that once symbolized Wall Street prestige had fallen apart. Newspaper front pages spinning onto screen. People on trading floors staring in disbelief. Global map lighting up with connected markets. And this is why Lehman matters so much. Its collapse did not stay inside one building. It sent shockwaves through the financial system. Because if Lehman could fail, who was safe? That question spread panic everywhere. Banks around the world, money market graphics, credit markets freezing, credit tightened, trust disappeared. Institutions became afraid to lend. And when lending freezes, business slows, markets fall, and fear becomes self-reinforcing. A company collapse had become a systemic event. Office workers packing boxes, families watching market news at home, retirement account screens falling. This is the human part people sometimes forget. These collapses are not abstract. When a financial system panics, real people get hit. Jobs disappear, savings fall, retirement accounts get crushed, and ordinary families pay for decisions they never made. Close-up of a retirement statement. Hands on forehead. Television showing market crash coverage. That is why Lehman became more than a bankruptcy story. It became a symbol. A symbol of leverage without enough protection. A symbol of growth without enough restraint. A symbol of a system that looked sophisticated but was more fragile than people realized. Dark trading floor. Lights flickering on screens. Silence after chaos. So what was the real mechanism of the collapse? Lehman made massive real estate-linked bets. It used extreme leverage to magnify those bets. Asset values fell. Confidence fell. Funding pressure intensified. Trust broke. Then the company ran out of room. Mechanism graphic. 1. Big housing exposure. 2. Heavy leverage. 3. Asset values fall. 4. Confidence breaks. 5. Funding disappears. 6. Collapse. That is the chain. Not one mistake. A stacked system of risk. And once enough pieces weakened at the same time, the whole structure failed. Executive portraits, boardrooms, tense faces, slow zoom in. Now let's talk about the psychology of the collapse. Lehman did not look weak in the way people imagine weak companies look. It looked prestigious. It looked experienced. It looked embedded in the center of power. That image made the danger easier to underestimate. Luxury offices, tailored suits, confident media appearances, graphs still being presented optimistically. This happens in many corporate failures. When an institution has status, history, and complexity, people assume strength. But status is not safety. Complexity is not control. And a long history does not guarantee survival. Masks cracking, polished glass tower fading into broken chart lines, The deeper psychological trap is this. People often confuse still standing with actually safe. A firm can look stable right up until the moment confidence breaks. That is why collapses feel sudden to the public. They are often fragile for longer than they appear. Leverage meter, warning lights, counterparty lines disconnecting one by one. Lehman's failure shows how fast perception can turn. One day, you are a giant. The next day, markets are asking whether you survive the week. In highly leveraged systems, trust is oxygen. Once it gets thin, everything suffocates fast. Whiteboard with lessons appearing one by one. So, what are the executive lessons here? Lesson 1. Growth can hide risk. First, growth can hide risk. A fast-growing business can look exceptional while quietly becoming more dangerous. If leaders only celebrate expansion and ignore what is underneath it, they are training themselves to miss the real threat. Lesson 2. Leverage shortens survival time. Second, leverage shortens survival time. The more borrowed money behind the strategy, the less room you have when conditions change. High leverage turns stress into emergency. Lesson 3. Confidence is an asset. Third, confidence is an asset. Not in a vague motivational sense. In finance, trust directly affects whether you can fund operations and survive pressure. Once credibility starts slipping, the damage can accelerate faster than leaders expect. Lesson 4. Complexity can hide weakness. Fourth, complexity can hide weakness. When systems get too complicated, warning signs become easier to explain away. That is dangerous. If nobody can quickly explain where the risk sits, then the risk is already harder to control. Lesson 5. Fragility grows quietly. Fifth, fragility grows quietly. Most collapses do not look dramatic in the buildup. They look manageable. They look temporary. They look like one more quarter to figure it out. Then suddenly, the window closes. Wall Street at sunrise. Aftermath mood. Quiet city shots. Lehman Brothers is remembered because it exposed how brittle the system had become. It was not just one bank failing. It was a warning. A warning that institutions can look powerful while standing on unstable foundations. And when those foundations crack, the damage spreads far beyond the company itself. Slow montage of traders, families, headlines, empty offices, financial charts collapsing. That is the part worth remembering. Collapse is rarely just an event. It is usually the final visible moment of a long, invisible buildup. Lehman's bankruptcy was the explosion. The fragility was already there. Channel end screen. Black background. Bold text. Next video tension setup. And if you think Lehman was shocking, the next collapse shows what happens when hidden risk, bad incentives, and false confidence keep spreading through the system. Watch the next video. Subscribe for more corporate collapses, frauds, and financial disasters.